Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hi, very good morning. You're watching Trading Hour on CNBC TV18. I'm Ekta Batra and with me is Lata Venkatesh, and we have seen a very good recovery come in for the market simply because of the softening that we've seen on the yields post the change in the additional government borrowing figure which came through around an hour earlier. So the Nifty is recovered around 70 points from the day's low. We have the Bank Nifty which is up around 0.4%, and we have a lot to reckon with outside the yield market. A lot of earnings lined up for today, the likes of Hindustan, Unilever, Adani Power and Bharti, Infratel, just to name a few. Hi, Lata.
Hi, Ekta. Well, you have said it all. The government, one master stroke, we will borrow less and all markets are cheerful. But how do we trade from here on now that the Nifty Bank is already 100 points higher? Sudardhan Sukhani of S2Analytics.com has joined us. Morning again, Sudarshan. Is there space to go long now?
Well, good morning. Yes, for the Nifty Bank, it is possible to go long even after this 100-point rally, but you have to keep tight stops. Your stops should be 50 points below where we are now. That's an intraday trade, and it is possible because this momentum could continue at least till the afternoon. If not, you have a stop loss. There is no trade in the Nifty itself, and it's best to step aside for the primary index. The markets are choppy. We have seen how we have fallen, then rallied. This is a sign of a choppy market, not really a roaring bull trend.
Okay. What would your stocks be?
Well, this is a buyer's market still, and we have Axis Bank because also we just discussed how the Nifty Bank could rally intraday. So Axis Bank is also a buying opportunity independently of the Bank Nifty. That's a buy. There is a sense of momentum in Axis and ICICI both. Consider buying Axis Bank, consider buying Dr. Reddy's. Dr. Reddy's has been an outperformer yesterday and today both, and that outperformance should continue. And finally, we have TCS from the IT pack, another sector which is outperforming. And so broadly the theme is be in stock specific say trades and just consider the Nifty Bank.
Okay, I just want to ask you about the public sector banks. Their fundamental problems are not gone, but there would have been a lot of short covering like there was in the bond markets. Is there any shorting trade now? It may perhaps be a better level to short because they are in the green.
Yes, Lata, I would think so. Any rally in the PSU banks is a shorting opportunity because the banks are not telling us that the trend is changing. This is probably only an intraday or a relief rally for whatever time it lasts. Okay. And to that extent, a position trader looking to go in short can select PSU banks. You get that much higher prices. Yes.
Okay, fair enough. Well, Sudarshan, let's get in some Twitter queries for you then. First up, Ashok wants to know if Wockhardt is a good buy at current price levels for a period of 1 year.
Well, I would say yes. It's a good buying opportunity. Wockhardt has gone through a severe bear market, but that's behind it. It's already started a run-up, and that run-up can continue for many, many more months, more than a year. So you'll expect, say, some dips in between, but that's normal. So Wockhardt is a buying opportunity, and it's an outperformer in the pharma sector. So I would say go for it.
Okay, here's a question on stock we don't normally get. Ravi has 500 shares of MMTC, which he bought at 79 rupees, wants to know a longer term view on the stock. Sudarshan?
It's a very difficult question to answer because there is no longer term view on MMTC. This stock has gone up and down on rumors so many times in the past many years. It's not once, it's done that many times. Why do you want to stay in a stock where we know nothing about it except rumors? I would say sell out, take that small loss. There are so many opportunities, private sector banks, IT, pharma. Go in for names that you understand.
Fair point, Sudarshan. We are spoiled for choice at this juncture. Thank you very much indeed for giving us your trading strategies and answering questions of the viewers. Well, now let's shift back again to the big story of the morning, the bond markets. In what was a big boost for this market, the government reassessed additional borrowing needs and has announced that it will have to borrow not 50,000 but only 20,000 crores extra, and much of that borrowing is done. So looks like there won't be any more government borrowing. But to discuss the impact both on bonds and on other markets, Ashish Parsati, Treasurer at HDFC Bank, joins in a bit. We'll also have Sahil Kapoor, the Chief Market Strategist at Edelweiss Broking. Good morning, Ashish. Thank you very much for joining in what's a very crucial moment for all markets. What is your sense now? No more borrowing till 1st of April?
Good morning, Lata. It's not that no more borrowing. Most likely, obviously, one auction could get cancelled. That's 15,000 crore, or they could reduce amounts in the remaining auctions by some amounts, 3,000 to 4,000 crores in each auction. So that's the thing. The markets did react to the statements, and we saw almost a 20 basis points jump from yesterday's close. But it has given up some of its gains. I think it's gone back to day before yesterday's levels, trading around for the new benchmark around 728 kind of levels, which is better than yesterday's close, maybe around close to 10 basis points better than yesterday's close. But I think it's at similar levels, very close to previous days, day before's levels.
Ashish, so what's your sense, at least in terms of the near term, where exactly the yield could head? Do you expect it to probably soften from current levels or maybe even harden?
So I think it's a very difficult question to answer at this point, because there are several events. The biggest event obviously is the union budget, and you will come to know of what kind of fiscal deficit they plan for the next year and what will be the size of the borrowing program. That's one. And then you obviously have the MPC giving out, telling us what is likely stance during the next few months. Inflation is more or less, I think the market is clear that you'll see higher numbers of inflation till June, July, and maybe see thereafter lower numbers. So more than most market participants are for an average inflation of at around anywhere between 4.5 and 5 for the next financial year. So that's more.
No, Ashish, suppose I were to ask you the yield movement up till the budget.
So I think there are not too many days left for the budget. So I think it will be extremely range bound. I don't see too much of a downside or upside to yields from these levels. There could be some gains on bonds till budget. That's quite possible, but those would be minor.
Okay. Well, we also have Sahil Kapoor joining us from Edelweiss. Do stay on, Ashish. Sahil, what are your budget math telling you now? Are you all translating the lower borrowing into a lower fiscal deficit?
So, Lata, we were working with a number where we said that there will be about a 33,000 crores of shortfall, which could lead to a 20 basis fiscal slippage. I think we'll probably go with that number still, unless and until we work out the numbers again. But today's announcement clearly tells you that there is a good possibility that this additional borrowing could be completely mopped up, largely using the better than expected proceeds from small savings. So I think that is one thing which will be comforting for the bond yields. And secondly, we still believe that there will be a slip of about 15-20 basis points given this new data, largely because the government has not stopped its expenditure. It's not toned down its expenditure at all. So that
how do you guess that? If they're borrowing 30,000 crore less, would it not be because they have cut expenditure? Where will that money come from? Are you factoring in higher RBI dividend and quicker HPCL sale? How are you working that 30,000 crore?
So two things. First, we feel that there will be a slip. Second thing, as I said, 20 basis points. Second thing, that one area from which they will get some additional numbers, of course, disinvestment proceeds. It could very well overachieve its target of 72,000 crores. And there is a slight possibility of an additional RBI dividend to the tune of 10 to 13,000 crores, which is not confirmed but quite possible. So these two numbers will be supportive. And second thing is quite clearly the government possibly by now will have some sense on how December and probably Jan GST numbers will pan out. So if you look at the overall basket, GST revenues will be about 36 to 38% of the overall government tax revenue. And if they were slipping by 10% there, you could see a shortfall of 3% to 3.5% on the overall number. And I think they are making up some part of it from direct taxes.
Okay. So Sahil, do you have an exact fiscal deficit percentage that you are now working with for this FY18 figure?
So we are working with a number of 3.4%. We feel that FY18 could be a 20 basis slip. And we had expected that even at 50,000 crores borrowing number, they could play around with more proceeds and from small savings, and therefore net borrowings will be lower. But I think this additional borrowing, whether it translates completely to a lower fiscal deficit, is still challenging.
Okay.
So I think,
No, I just wanted to get Ashish in. Ashish, you said that it would be rangy till the deficit, till we know what the budget says. And yes, of course, after the budget is the monetary policy and further inflation numbers. But what is an educated guess in terms of the yield movement up until March 31st, say?
Up until March 31st, again, as I said, very event dependent. But I think, you are at 728 for the new thing. I think we should see a range of around, I would say anywhere between 720 to 735. I think that would be the range for now till March.
Okay. How are you reading the announcement at all? Are you also assuming lower fiscal deficit? What will be the assumptions behind this 30,000 crore cut in borrowing?
See, I guess, one goes by what they say, and, it's always the case towards the end of the year, there would be, basically adjustments in the collections as well as in spending. Everything doesn't get spent because, not because maybe there's a deliberate cut, but just because it doesn't get spent. There's capacity to absorb, there could be several things which don't go right with projects, etc. So, I think fiscal deficit, there could be a slight slippage, maybe a 10 to 15 basis point slippage from, what they had budgeted. And I don't think they will go too away from, the fiscal roadmap next year. They could just, maybe at best 10 basis points from what they had assumed, 3 to 310, but that's about it. I don't think they will do too much with the fiscal math, at least in the budget. So I think it should be, I don't think budget would cause, again, a very big move, but it could be slightly positive when they present the budget.
Ashish, what is the yield currently factoring in when it comes to, say, an RBI move of a possible hike, and by when, if in case that is something that you're working with?
So I think there is, it hasn't, I don't think a full hike has been factored by all participants, but yeah, the possibility of a rate hike in, sometime second half of this year, yes, that is something which the market is kind of factoring, let's put it that way.
Okay, I guess things will crystallize after we hear the deficit number and the next few inflation numbers. Ashish Patsarthi and Sahil Kapoor, thank you very much for joining in this discussion. Well, yes, there could be a little bit of expenditure cuts and a little bit of revenue that's coming in probably from direct taxes. But at the moment, expect a rangy market from bond side. So at least one worry less for the equity market. All indices in the green and the mid-cap index almost getting there. Let's hand over the baton to our commodities editor, Manisha Gupta, who has a guest with her, Mark Keenan. Hi.
Thank you so much for that, Lata. Well, absolutely. The last year was a grand one. I mean, you had everything working for itself, right from industry capacity cuts, environment cuts. You also had financial deleveraging and demand for raw materials. And that really took all of those commodity prices higher in 2017. While we have seen this year start on a positive note as well. But let's find out from Mark Keenan himself on where does he expect many of these commodity prices to go on for the rest of this year. Mark, hi. Always a pleasure to have you with us. Let's start with the crude oil prices first, because we've seen nearly 6 to 7% of gains in the first 10 to 15 days of this year. Of course, right now we are off those 3-year highs. But what is your sense? What are you watching out for? And are we going to hold above these $70 marks?
Good morning. Yes, thank you for having me. We have quite an unusual situation in the crude oil market at the moment. And at Société Générale, we like to think of the commodities sometimes in terms of their support functions. And at the moment, we have sort of a three-legged stool in place. We have three pillars of support. We have the fundamental outlook, which is certainly very supportive at the moment. We've also increased our price forecast because of the supply-demand outlook. Secondly, the second leg is the geopolitical risk backdrop that's been very supportive of late. And thirdly, possibly the thing that we need to focus on the most with respect to where prices are going is the positioning profile. We have extreme speculative length in the crude oil market at the moment, approaching 1 billion barrels of speculative length. And for that reason, and also for some of the strength in some of the other commodities, this is the key risk factor that's on our radar screen. It's taken commodities, specifically oil, in excess of their fundamental values in terms of what our analysts are thinking. And we sit awaiting a trigger or a catalyst that's going to cause that speculative length to unwind and move prices lower.
So, Mark, what is the risk really? I mean, as you said, the speculative money is huge when it comes to the long side. If there was a profit-taking that was to come, where do you see a support coming in? And because of the strong fundamentals, where do you see a resistance coming in as well?
We've just increased our fundamental price forecast in the last few days, if we talk about Brent, up to $62 a barrel. And so even having done that, that means that we still remain bearish with respect to forward prices and current prices. So there's about $6 or $7 of risk premium in the market currently. So that's where we would expect prices to fall to. What is going to cause that? It's difficult to tell. If we look at why we've got up this far, you know, number one has been certainly the very cold winter that we're seeing in Japan and in North America. That's been a supportive factor. That won't last forever. Some of the geopolitical risk issues are starting to ease now that we passed the day last Friday when Trump potentially had the opportunity to not sign the sanctions wavering with Iran. Sure. That was a source of some concern in the market. And a little bit of easing in some of the other areas like Libya, like Iraq, and so on. And notwithstanding, as we move into Q2 of this year, that is the seasonal slowdown period. So any one of those factors may cause the speculative length to consider whether they should keep these positions as large as they are and possibly trigger a down move.
Point taken. So, Mark, very quickly also, what's your sense on the U.S. shale output at these current levels, the OPEC compliance that continues? Do you see the OPEC and Russia continue to cut oil output production for the rest of this year?
We do. We expect OPEC and Russia to maintain their compliance for the rest of this year. We expect the U.S. production, shale production, to increase up to about 1 million barrels of crude production this year. But at the moment, much of that growth is being offset by declines in some of the OPEC-producing countries like Venezuela, for example, and, of course, Iraq as well. So it's a broadly balanced market. In the context of resilient demand has caused us to increase our forecasts moderately from before up to $62. But we certainly expect OPEC and Russia to maintain their output quotas as we move throughout the rest of the year.
Mark, would also want to take your views on the metal space, because last year was a phenomenal one. We've started well in this year as well. China, of course, has overtaken many other consuming countries when it comes to various commodities, right from, iron ore to soybean. So as to say, for this year, what are you looking at in sense of metals? And do you see stronger demand as one of the major factors that would continue to support?
Yes, the base metal complex has done very well, as you say, last year. It continues to be supported by dollar weakness at the moment, by anticipated supply deficits and declining inventories. Again, as with crude oil, the positioning profile in the base metals is also extreme long positioning, taking some of the markets at the moment to levels that are in excess of their fundamental valuations. In terms of which metals we're focusing on, in terms of which ones could have more upside from here, we think nickel, we think lead, and copper, even though copper is slightly ahead of its fundamentals at the moment. We have an interesting year ahead of us insofar as about 20 20 production contracts out of Chile are due to be renegotiated. And typically speaking, when you have high metal prices, as we do certainly in copper, that tends to stimulate wage renegotiations, strike action, and output disruptions. A little bit like we saw last year at the Escondida mine in Chile and some of the others in the region. So we expect output disruptions to remain elevated in copper, so that's also looking like we could see higher prices this year. But as a complex supportive, specifically lead and nickel, further upside.
All right. And what's also your sense for the gold and silver prices going forward? Do you expect the US dollar to continue to weaken? Because that would be one major point to watch out for.
Well, that has certainly been very supportive for gold of late. Our view on gold is negative for the rest of the year. We see, to try and attribute what's been driving gold recently, one of the things we find helpful to do is look at things like ETF holdings. And they've been very constant, certainly for the last 2 to 3 months, indicating that there's been no real change in the outlook in terms of demand, potential safe haven demand for gold at all, which means that the move in gold has probably been largely driven by currencies. And our quantitative analysis suggests that about 40% of variance in gold is currency related at the moment. In the context of 3 interest rate hikes for this year, lack of any physical demand in Asia, increasing in recycling in Asia of gold, we have a negative view on gold, about $100 downside from here, down towards 1,200, 1,215 for Q4 of this year.
All right. Well, Manisha and Mark Keenan, thank you very much for what was a very enriching conversation on the way the 3 stools of the 3 pillars of the commodity markets are positioned at this point in time.